Richard S. Lehman has over 35 years of practicing tax law in the United States. Mr. Lehman has had extensive experience with all areas of the Internal Revenue Code that apply to American taxpayers and non-resident aliens and foreign corporations investing or conducting business in the United States, as well as U.S. citizens and domestic corporations investing abroad. Richard has a national reputation for handling the toughest tax cases, structuring the most sophisticated income tax and estate tax plans, and defending clients before the Internal Revenue Service. Richard Lehman began his career in tax law with a law degree from Georgetown University, a master's degree in tax law from New York University, and 2 years of clerking for the Honorable William M. Fay, a judge on the United States Tax Court in Washington, D.C. He spent several years as the senior attorney of the interpretive division of the Chief Counsel's Office at the Internal Revenue Service, the IRS's internal law firm. Today, Richard works with other lawyers, accountants, business leaders, and individuals who are struggling to find their way through the complexities of United States tax law.
We're going to talk about the way the United States taxes non-resident aliens and foreign corporations. That's what I'm calling the foreign investors. Non-resident alien individuals and foreign corporations that come to the United States strictly for business and investment purposes. I want to start by distinguishing the non-resident alien individual from the American taxpayer, who is either a United States citizen or an alien individual who has become a U.S. tax resident for U.S. income, gift, and estate tax purposes. I think everyone's familiar with the taxation pattern of the United States citizen, which also applies to the United States resident alien. Now, this is not resident for immigration purposes, which is a different definition. Americans are taxed on their worldwide income annually. They're taxed on their worldwide assets when they die. And they're taxed on any gifts that they give during their life, on their property held all over the world. Let's first identify the foreign investor. The two groups, the non-resident alien individual and the foreign corporation. The foreign corporation is any corporation not organized in the United States of America. The non-resident alien individual, what is a resident alien individual? A non-citizen individual investor in the United States starts off being a non-resident alien. However, they can become a resident alien for U.S. tax purposes, income tax purposes now. We're going to distinguish also in this course that there's a difference between residency for U.S. income tax purposes and residency for U.S. estate and gift tax purposes. A non-resident alien becomes a U.S. resident for tax purposes in several different ways. A non-resident alien becomes a resident alien for income tax purposes is to obtain a United States green card, which is permanent residency in the United States. The second way a non-resident alien becomes a resident alien is by being in the United States too long in any given year. This is called the substantial presence test. The third way a non-resident alien becomes a resident alien is a voluntary election by the non-resident alien. For example, what if a non-resident alien gets married to an American and they want to file a joint tax return? They won't be able to file it as a joint tax return with one U.S. resident and one non-resident alien. The next two items there, items 4 and 5, the closer connection and the effect of United States tax treaties on the residency status actually probably belong more under the heading of if you're here and you are considered to be a resident alien because you've been here too long under the substantial presence tests, are there any exceptions that possibly can still help you maintain your status as a non-resident alien even if you've been here too long? So we'll cover the closer connection exception and the effect of treaties after I've gone through the chart and explained the substantial presence test to you. The substantial presence test is essentially an objective test to determine tax residency. Up until the mid-'80s, there was a very subjective test as to residency and way too much ability for people to claim non-residency for tax purposes. So this was modified in 86, I believe, to make whether you're a U.S. resident in any given year for tax purposes a strictly objective test. And this is what they have decided to do. Over a total of the last 3 years, based on a formula, you have been in the United States for a total of 183 days or more in that year, you're going to be considered a United States resident alien, and you're going to be subject to all those worldwide taxes that the typical American is subject to. The right-hand side of the chart is going to show you the person who came to the United States for a total of more than 183 days or more in the year 2010 and caused themselves to be taxed as a resident alien. The left-hand side of the page is an example of the non-resident alien who comes to the United States for a 3-year period that is sufficient to keep them under the 183-day total and therefore avoids resident alien status for tax purposes. Let's look at the left-hand side, which will be the non-resident alien who stayed non-resident alien. That taxpayer spent 120 days in the United States in the year that we're determining whether they're a resident in each of the 2 prior years. You see, if you use my formula, the 2010 year is counted as 120 full days. 2009 is a third of the days spent here, or 40 days. 2008 is a sixth of the days spent here, or 20 days, falling short of resident alien status. If we look at the person who tripped over themselves and made it to resident alien tax status for 2010, you'll see there was one difference. In the year 2009, they spent 150 days in the United States, not 120. Therefore, they had 50 days counted towards their residency days, not 40. And consequently, with a total of 190 days in the U.S., they're resident aliens for the year 2010. There's one other thing I'm going to mention, because there's several things like this which are so unique they're not really worthy of a lot of comment. But there's some very unusual ways to also come to the United States, enjoy the benefits of the United States, and not be considered a resident alien and stay here for much more than 183 days every year. And I chose one of them. A foreign student who comes to the United States will not be taxed on their foreign income while they're here as a student. Now, it just happens that foreign students can have at times, their families ride on their student visa and also come to the United States for the extended period of time of their student visa without needing to limit their stay here and not be subject to their tax on their non-U.S. source income. So one example of which is actually a case I had, a South American woman who came here in age 40 for a college course in cooking. Her husband was a very wealthy individual, made $1 million a year or more only from his foreign source businesses. He and the children were able to stay in the United States for several years without paying tax on their only income, which was their foreign source income. So there's some things to keep your eyes open in some unique situations. That's an example of one. I hope now that we've defined the foreign investor, the taxpayer that we're talking about, either the foreign corporation that's invested in the U.S. or the non-resident alien that's invested in the U.S. The investor that we're talking about, this is the person who is coming to the real estate broker and saying, I'm investing in real estate here, coming to the lawyer, the accountant, saying, what do I do? I'm investing here. That non-resident alien or a foreign corporation, either one, are subject to their own tax jurisdiction. Basically, they are subject to the U.S. income tax, but generally only on income that they earn from United States sources, which we'll define. They are subject to a U.S. estate tax, but only on assets they own that are situated in the United States. They are subject to a U.S. gift tax. Again, only on real and tangible personal property with a United States situs. On this chart, I've listed one more tax. This is a tax Americans are not subject to, that foreign corporations only, not non-resident individuals who come here, but foreign corporations only, will be subject to another kind of tax called a branch tax, in addition to their income tax. The branch tax is only asserted on corporations. And again, not from treaty countries, because if you're from a treaty country, the branch tax is usually going to be struck out completely. But if you're from a non-treaty country, you come to the United States and you do business. You open a manufacturing plant here. You make $1 million the first year. You pay your income tax like any U.S. corporation. And then you turn around and you say, gee, I want to pay a dividend out to my investors. Well, at that point, your investors are receiving a taxable dividend, from a dividend taxable by the United States, because its source of income was United States source income. Therefore, there's going to be a 30% withholding tax on that dividend if you're not in a treaty country. Well, the next step by the corporation is to say, my God, we don't want that to happen. We've got a 30% tax on top of our corporate 34% tax. There's nothing left. Let's keep the cash here. And then we'll just build up the cash. When we've got $10 million, we'll liquidate this company, and we can pull everything out tax-free, which we'll get to that also. But America doesn't want that. They don't want you to keep cash earnings here in the United States, if you're a foreign business person doing business here, that stay idle, that should be paid out in dividends. So if your money is not reinvested in your business, and that what's left of that $1 million after your U.S. taxes are left in your business, just in a savings account, that company's going to be subject to a branch tax of 30%. Give you an example of how we put all of this together, adapt to a few more rules that I'm going to make you aware of, to do some tax planning for these people and corporations. What I've chosen was to isolate out a major type of investment in America, which is United States real estate, and be able to show how we do some estate tax planning and income tax planning to real estate investments. Many of these rules are going to apply to other types of United States investments in the United States. And they're going to apply, but they're going to apply only to those foreign corporations or U.S. individuals that actually are doing business here in the U.S., not to the ones that are investing here. I'm going to start with covering the real estate investor. And here, I'm just taking the liberty of want to pass on some practical advice because of just being in South Florida. So much one deals with here is real estate investments in the United States. For any professional lawyer, accountant, real estate broker, anybody who is dealing with these people. The practical advice is that now is a good time to invest in the U.S. real estate market because everything has really gone down. And we have the same old staple of potential investors still around. My trademark, I've always said, find me the country that's making the most money with the most scared people. And that'll be your new big group of investors into the United States. First of all, if you come to the United States now and you're going to put substantial cash in a deal and you're strong, like other people who are strong in America, there's money available if you don't need it. So you can put some leverage into your investment here at very cheap money. All right? That's the first thing that the strong foreign investor can do. The next thing to keep your eye on is the countries that fit my category of making money and or being fearful. And here I'm going to give you examples such as Russia, China, Brazil, India, Israel, South Korea, and Canada. Those are the ones that are more on the strong side, with, I guess, Russia still fitting into the scared side. Then we've got the scared side. Venezuela, Spain, Latin America in general. Another group of people anxious to get into the United States real estate. And finally, you've got Western Europe, which has historically always been the biggest investors in the United States. England, France, Germany, Netherlands, Belgium, Italy, some of them with collapsing real estate markets, all of them with an insecure monetary system at this point. So there's business to be had out there. The foreign client needs somebody who is tuned in to him or her, who, and most of all, they need a professional team, all of whom are independent from each other, and all of whom can come to that foreign client and give that foreign client the straight advice that they need. They need a real estate attorney, they need a tax attorney, they need an accountant. They usually need more than one broker so that they have a wide choice of properties and they need an appraiser or two that they can trust. If anybody in this chain, any link in this chain fails, I can tell you the history of the foreign investors. The history is they come in and they do one deal or two deals the right way, and all of a sudden, instead of 1 Brazilian, there's 10 Brazilians on your doorstep. Do their first deal wrong, their second deal wrong, mess it up because one of those professionals was either compromised or incapable, and you're never going to see that person again, and most likely the United States is never going to see him again. Because you have to understand, when you're sitting in Mumbai managing the business that allowed you to invest in the United States, the one thing you don't want to hear is, you know, the passive investment you just put into that rental units that you bought here, it's all in a mess. You better get over here real fast and drop what you're doing. When anyone in that team doesn't know what they're doing, that's usually the outcome of an investment, of a complex investment in U.S. real estate. The taxation of United States real estate really has a historical perspective to it. Up until the mid-1980s, our tax laws, when it came to taxing foreigners, were nowhere near as tight as they are now. And the loosest place they were was in United States real estate investment. So long as a foreigner invested in a Netherlands Antilles corporation and then invested in the United States in their Netherlands Antilles corporation, they never paid tax. I don't care what type of income they earned, how they earned it, where they earned it. If they earned it in real estate and a foreigner came here in a Netherlands Antilles corporation, a good tax lawyer would find them a way to not pay tax. And I guess that was too good to be true, because it ended with a whole brand new section of the Internal Revenue Code being carved out for investments in United States real estate. What this new tax regime as to real estate did was to make sure that the United States got at least one single tax out of a foreigner's investment in the United States. The problem with it is that they made it so complicated to ensure that the one tax was paid. If you don't know what you're doing and you do it wrong, investing in the United States real estate, you're going to pay 4 taxes instead of 1 tax. And that's something to be concerned about. What makes the tax planning for the non-resident alien individual, at least, a little more, even more difficult in real estate is because, as we discussed, real estate is a U.S. situs asset. So a non-resident alien individual that comes in here without any planning winds up exposing themselves to both estate tax and income tax. So even more reason to be very careful and know what you're doing in this area. With any foreign investor that's coming in here is, are they going to pay tax on this income in their own country? Because if they are, and if they're going to be reporting it there, you're going to be able to avoid them paying a double tax on U.S. taxes on the same income that they're paying foreign taxes on, as a general rule, whether it's through use of a tax credit or under a treaty. But you can't analyze a foreign investor's tax position and do any kind of planning with them without knowing what's going on in their home country. Keep in mind, as we start off looking at this real estate investment, there's a potential annual income tax, there's a potential capital gains tax, there's a potential estate tax, and a potential gift tax. Now, the gift tax and the estate tax are not going to apply if a foreign corporation is the investor instead of a foreign individual. However, what you're going to see Once we involve the foreign corporation to save estate taxes, we may be causing the taxpayer more income taxes, which we also need to plan for and take into consideration. The U.S. annual income tax will apply to non-resident alien individuals and foreign investors that make annual income from real estate. The capital gains tax is also going to apply to both of them. Now, at the corporate level, the capital gains rate can go as high as, is not taxed as capital gains, so the rate can go as high as 35%. The individual investor, the rate is going to be taxed at the capital gains rate and will stay at 15%. So you can see right there one of the big trade-offs in doing some tax planning. The individual preserves the individual capital gains rate. The corporation is taxed on ordinary income rates on its capital gains from the sale of its real estate. The estate tax is applicable because the United States is U.S. situs real estate. The gift tax, too. It's a U.S. situs asset when we're talking about real estate, with gift tax that can be as high as the estate tax if a gift is made by the non-resident alien owner of that gift. And we covered the branch profits tax, which we have to keep in mind as a new type of tax that could hit this foreign corporation. So with the foreign corporation, we trade in the estate tax and we buy two potential problems that can be dealt with but need to get your attention. The income tax that a foreign corporation has on its income earnings, the capital gains tax that it has on its sale of U.S. real estate, and the branch tax that may accompany the taxation of its income. The various types of entities that we can use for a non-resident alien individual and foreign corporate investor, and what each type of entity will do tax-wise for that foreign investor. After that, I'm going to overlay some of the unique tax planning tools that can be used once the right structures are in place. You need to first keep track of how much is being invested, because a more sophisticated entity might be too costly for the deal. You need to know whether the investment is long-term, short-term. That's going to have an entity determination. The nature and the relationships of the investors could become important. If there's 10 different investors in one deal versus one investor in a deal, you're going to see there's a lot more tax planning that one can do with 10 investors than with one investor. So there's a lot of, before you even come near adopting the right entity, a lot of information is necessary. Profitability, anticipated profitability, so many things. But let's walk through the entities, and I think by using the charts and me commenting on these, on the advantages and disadvantages, you will get a feeling of maybe what fits and what doesn't fit. We're going to start off with individual ownership of a piece of U.S. real estate. The advantages are an individual, non-resident alien that invests in the U.S. is going to be taxed only on their U.S. rental income from the real estate, none of it's their foreign source income, at U.S. rates. So consequently, somebody may make $1 million overseas and make $50,000 here. They're only going to pay tax on that $50,000, which is going to be in very low income tax brackets. And they have the advantage on the sale of the property of paying only in the 15% capital gains bracket on the sales proceeds. So individual ownership is a wonderful income tax approach. It's disaster for estate taxes. So if you've got a large investment, you have the potential of the estate tax if the treaties don't apply. You have the potential of a gift tax if that taxpayer wants to make a gift. As a practical matter, you have the disadvantage of unlimited personal liability. And I think you'll find that a lot of foreigners don't want their names disclosed. They don't want that headline in the paper that Mr. Rodriguez just bought a $5 million piece of property in downtown Miami, because Mr. Rodriguez finds out that every kidnapper in his home country knows about it the next day. So you have the disadvantage of ownership disclosure with a foreign individual's name on the deed. So it's only on rare occasions that I see this as a real smart tax planning tool. The next one is individual ownership through a limited liability company. Now, the only difference here, everything applies that we said about individual ownership, except you don't have unlimited personal liability, and you don't have disclosure of the ownership of the real estate. So if you're going to stick with an individual investor, because it's a small investment, so there's not going to be an estate tax, or we find other ways to solve the estate tax. You don't go, I don't believe, individual, you go the limited liability route. But there's nothing to be said against the individual ownership rule, or no difference between limited liability company and individual from a tax standpoint. Next, let's put the individual in a U.S. partnership or a foreign partnership. It won't matter, because it'll be a foreign partnership that's doing business here if it's a foreign partnership. Here, again, almost everything is the same as the individual ownership. You've got the capital gains tax break and the sale of the property. You've got your annual income tax only on your U.S. situs income. And here you have limited personal liability, no disclosure of ownership. Very much the same as the limited liability company. Again, you've got an estate tax and a gift tax to deal with, however. Not on the real estate, but now you're paying on the entity. You're paying on the non-resident alien's individual interest in the partnership here in the U.S. Now let's move to using entities to separate the individual investor from the investment. Taxation. The first thing that one needs to be aware of, which I've said already, but you step into a world of higher income taxes once we're using the entity. And you step into a world of excessive, unnecessary income taxes if you're not paying attention to things. So once we take this step into the entity, we have to know why we're doing it, and we have to know how to stay away from the traps. Let's assume the non-resident alien individual, again, not in a treaty country that may affect this, sets up a United States corporation to own real estate in Florida. Now, the first thing they're doing is, in several instances, adding a state income tax on top of their regular corporate income tax. So that entity adds a state tax, a second tax to the U.S. federal tax. You need to be aware of that. It's a deductible tax, so if it's 5%, maybe it's really 3%, but it still adds onto the tax burden. When the investor invests in a U.S. corporation, they have graduated corporate income tax rates, which get up to the 34% tax rate pretty high. All right? There's no branch tax because it's a U.S. corporation. And here's the one advantage tax advantage that you find in the United States corporation that could be helpful in limited situations. You can make a gift of the shares of a United States corporation, of that intangible. You can make a gift of those shares free of United States gift taxes. So therefore, if you own property in a U.S. corporation, you could make a gift of the shares, get the shares out of your estate for estate tax purposes as a non-resident alien, and pay no gift tax on the transfer. Other than that, the foreign corporation by itself is not usually a real entity of choice, because the estate tax will still apply, while a gift of shares in a U.S. corporation is not subject to the gift tax. Shares in a U.S. corporation are considered U.S. situs assets for the U.S. estate tax. So you have the estate tax that could apply anyway, even though you've gone into corporate ownership. You have your capital gains no longer being taxed at the 15% individual rate, but going up to the highest rate, which would be 34% up to 10 million, and then 10 million above 35%. And you now enter that world of maybe needing to pay dividends out from a corporation to a non-resident alien owner, and possibly running into the withholding tax on those dividends. So there's ways to deal with these, but those are, that last one, the dividend tax, there's ways to deal with that, let's say. But those are the things that one needs to be aware of going into the domestic corporation. The individual that uses a foreign corporation to make their investment in the United States. The foreign corporation does start to give us some advantages, and as we mentioned, some disadvantages that have to be paid attention to. The foreign corporation does away with the United States estate tax. If a non-resident alien individual owns a corporation organized outside of the United States, and that corporation either does business in the United States or, as we'll get to, sets up a United States corporation to do business through, there will be no estate tax. That's because when the non-resident alien individual dies, the non-resident alien individual passes not U.S. real estate to their heirs, but rather shares of a foreign corporation. And the United States has no jurisdiction to assert an estate tax on a non-resident alien individual who passes by inheritance shares in a foreign corporation. So the estate tax problem is solved. What you have to watch out for, like in the U.S. corporation, capital gains being taxed at ordinary income rates, and ordinary income rates that go in the higher tax bracket much quicker than they do with the individual tax bracket. Here you have the branch tax to consider. There's one other thing that you need to be aware of that's a negative here on the foreigner who invests in a foreign corporation to invest in the U.S. That is that these things become expensive. Not outrageously expensive in most countries, but they can really be a burden that it just can't justify itself in a small deal. But advantages: no gift tax on transfer of shares, no estate tax. The next entity is the most sophisticated, really, of the different tax planning techniques, and the one with maybe the most traps in it also. And I call it the individual who invest in the United States in a tiered entity. The individual who sets up a foreign corporation to make sure they have no estate taxes, and then has that foreign corporation own a United States corporation 100%, so that there's no branch tax, and so that they can do their tax planning down at the corporate, American corporate level, to the direct owner of the real estate, the American corporation set up by the foreign corporation to own the U.S. real estate. Benefits: no estate tax, no gift tax, no branch tax because you have a U.S. corporation that's doing business, not the foreign corporation. No disclosure of anybody's interests, no unlimited liability. And a good deal of flexibility for income tax planning. The downsides, principally, that capital gains is taxed as ordinary income to a corporation. By the time you're using a corporate entity that's using a domestic entity to invest in a United States real estate asset, you're in a decent size investment. And hopefully you're looking for a decent sized profit. By the time your profit is subject to the corporate income tax and a corporate state tax versus the 15% capital gains tax that you would pay while staying as an individual, you're talking about significant increase in taxes. That's why a lot of thinking has to go into this. And finally, there's one other type of ownership that I've put on the chart, not strictly in line with these other entities, but we've seen it used, and I've used it myself one or two times. But it's infrequent. And that is what we call using the non-grantor trust. What it means is the investor who really puts the money into the U.S. investment has to pretty much give up almost all of his rights to ownership, control of the asset, to an independent trustee. And that independent trustee will be acting for independent beneficiaries, such as the investor's family. In that situation, since the investor may have put the money in but doesn't own anything, the trust owns the asset, there isn't going to be an estate tax. And one can still get the income tax rates and 15% capital gains tax rates that apply to individuals, because that trust can enter into the United States and elect to be taxed as an individual. Now, good tax planning, the best of all worlds, let's say. Lower income taxes on sale, because the capital gains tax that applies to individuals will apply, and no estate tax, because no ownership of the asset. However, there's a big move to give up dominion and control over this thing in order to save taxes. So that's why they're used few and far between. The tax planning opportunities. And I've carved out 4 different tax planning tools for us to focus on. I think it's important that you know that I'm really only touching the surface on this, because it's supposed to be a kind of a general course. The liquidation of a corporation that invests in U.S. real estate. If you remember at the beginning of the discussion about U.S. real estate, I told you that the United States was interested in at least getting one tax out of the foreign investor in the United States. They assured that by putting an exception, or rather they assured that they wouldn't get more than the one tax unnecessarily, or if it wasn't by mistake, by putting an exception in the Internal Revenue Code that governs corporations that invest in United States real estate. And basically, that exception, Code Section 897C, what they said is that once a corporation that invests in U.S. real estate, whether it's a foreign corporation or a domestic corporation, once it pays all of its U.S. taxes on all the real estate that it owns in the United States, it can liquidate and it can distribute all of the cash that it has from the sale of those assets free of tax to the investor. In other words, the company doesn't have to pay a dividend out to an investor. It doesn't have to pay an investor that 30% tax. Again, I'm talking a company that's not running afoul of the branch tax, but a company doesn't have to pay any dividend taxes. So it's possible to structure your investment and have a domestic company that owns the United States real estate that's not subject to the branch tax and that is not forced to pay out its cash investments as dividends, have that corporation owned either by the non-resident alien or by a foreign corporation. And when that domestic corporation or a foreign corporation doing business here and owning that real estate directly pays its one tax on all of its real estate, it can take all the cash that it has acquired, and maybe if it owns one piece of real estate, it's all the cash that it acquired from that one sale. And instead of distributing at a dividend, as a taxable dividend, the company can simply liquidate and transfer it out, payable tax-free, to the non-resident alien investor or foreign corporate investor that owns that United States company. This is where the IRS tried to give some kind of parity to foreign investors, because the typical American investor has very much switched over in real estate investments to limited liability companies, partnerships, entities that don't impose that double taxation problem to begin with. The foreign investors can't do that because of the big estate tax problem they have. So in order to give some type of parity, the tax code says if you have a corporation here that owns U.S. real estate and it's paid all of its taxes on its real estate and it liquidates all of the funds that it's distributed out, which would ordinarily be treated like capital gains to the shareholder, those are not taxable funds at all. So the first planning tool, of course, is try, where possible, not to put more than one asset in a U.S. corporation that you're investing in to own your U.S. real estate. If it's a bunch of small deals, you may want to use just one corporation. However, if you use one asset per one corporation, you sell that asset, you pay the corporate tax, you liquidate the asset, and your money's out of the United States without a second tax. Now, if you've chosen to put 2 or 3 assets into that corporation, keep in mind the law is you have to have sold and paid tax on all your U.S. real estate to be able to liquidate free of tax. So the trap that happens is, let's assume in one U.S. corporation, you bought 3 assets for $10,000 each. One of them is worth $30,000 today. One of them is worth $10,000, and one of them is worth $20,000. Well, if you sell the $30,000 asset and you want to get that $30,000 in cash out right away, tax-free, you go and liquidate that corporation, and what's going to happen? That corporation has 2 other assets in it. One asset costs $10,000. It's only worth $10,000. So when that asset gets distributed out, there won't be any tax because there's no gain. But the other asset that's not sold cost you $10,000. It's worth $20,000. You want to liquidate that company, you've got to transfer those 2 assets that still exist along with the $30,000 cash out to your foreign investor. That means that your corporation had to pay an additional tax on the $10,000 in paper gain in the $20,000 asset that you've had to distribute. So you got to be careful in making use of this liquidation tool. If you look at the chart marked corporate liquidation that has on it step 1, 2, and 3, you'll see the difference in the bottom line of liquidating the company, a company with gain right away, or paying a dividend out and receiving your money out that way. The next tool we're going to talk about is the portfolio loan. Now, as a general rule, as we discussed in the beginning, if a foreign investor receives interest income from a United States corporation, a United States person, any United States entity that might be investing in real estate, for example, if a foreign person lends money to that entity and receives interest income, the entity has a cost. So if it's a foreign person lending money to a United States partnership that invested in a United States real estate asset, the partnership, in determining its taxable income, will be able to deduct the interest cost for the money used to acquire the asset that was invested as a debt by the foreign investor. That reduces the partnership's U.S. taxable income. However, if you recall, that foreign investor is going to have to take that interest income in and pay a 30% withholding tax on it, absent any treaty provisions. Now, that's a very expensive deduction if the foreign investor is also investing in the same deal, because the deal might not be producing a lot of money in the beginning, and yet interest is going to be paid out to him to build up losses for interest payments, and he's going to be paying tax on that interest income in advance. It may be his own money that he had to put in to pay himself the interest income to produce the tax deduction. There's an answer to that if you play by the rules. The United States, in order to encourage debt investment in the United States, allows for something called a portfolio loan. So long as a loan by a foreign investor meets certain criteria, which are not difficult to meet, most of them are formalities, the interest paid by the U.S. deal that's deductible by the U.S. partnership and then paid to the foreign investor is not going to be subject to that 30% tax. So by using a portfolio loan, you can have a foreign investor invest in a United States deal, receive his return, his or her return, in tax-free investment income, while the deal is receiving a tax-deductible interest payment advantage, reducing the overall taxes. Too good to be true? Well, not too good to be true, but the rules are strict. The rules are, all of this works so long as the foreign investor does not own 10% or more of the deal that he's investing in. Now, I can't tell you how many variations on this theme get played all of the time in arriving at a portfolio loan that works and allows both investor and investment to benefit from this tax advantage. But you've got to be careful, because the moment any investor has more than 10% in the deal that his monies are being lent to, that's the 30% tax is going to be back on. And it's usually more expensive than it's worth. I have tried to provide two of the simplistic examples of the portfolio loan use for you. Portfolio loan sale. Let me give you one example. And again, the chart without the discussion could be misleading. If this was in a corporation, I assumed that $200,000 gain would be worth, or would have a tax cost at 35% of $70,000. That means that the taxpayers purchased the property, made a $200,000 profit, walked away with $130,000 net. Now, look at what I did in the second example. In the second example, under sale and liquidation, I assumed that the property was not sold for $1.2 million, but sold for $1 million to the buyer. And I assumed that the seller said to the buyer, I'm going to sell you this on terms, and I'm going to sell it to you for less money. I'm going to sell it to you for $1 million, and then I want, over a 2-year period, let's say if I was entitled to 5% a year in interest, I would be entitled to $100,000 in interest. And now I want to tack on to that another $200,000 in interest for the $200,000 discount I gave you off of the property. I'm going to have you give me $1 million note and pay 15% interest a year for the next 2 years. Now, keep in mind, I'm stretching the example to make a point. But the bottom line is, over that 2-year period, the foreign investor gets the same $300,000 back that they would have gotten if they had gotten, and with no tax whatsoever. That's how portfolio loans are used. The like-kind exchange. This is going to be familiar to most of us as Americans. It's going to work the same for a foreign investor who invests here as an individual or in a partnership, or whether they come here in a U.S. corporation or a foreign corporation, so long as they're exchanging like-kind property and it's inside the United States, they're going to be able to use the like-kind exchange rules and defer taxation like everybody else. A lot of foreign fortunes have been built on this. There's one quirk in the U.S. tax laws when it comes to investing in real estate. That quirk is that if a foreign corporation invests directly in United States real estate, or it invests in a company, a domestic company that might own the United States real estate, if it can get somebody to buy the shares of its foreign corporate stock instead of the real estate, the shares of the foreign corporate stock can be sold for no tax whatsoever. Now, you might say, well, who's going to do that? Who's going to buy a built-in tax liability and let the foreigners walk away tax-free? Believe it or not, there's a market in this. And I'll tell you how the market works. And I try to show it in my example. I used a foreign corporation as the owner of the real estate. The non-resident alien individual would see, bottom line, from the sale of the example I used, which is a $10 million purchase price and a $20 million sales price, and I assumed, again for simplicity's sake, a $10 million profit. I assumed the foreign corporation would pay about a 33.5% tax, and the net to the seller after liquidating everything would be $16,650,000. Here's what the market is in these things is all about. If you'll go to step 2 of that chart that deals with this, we've assumed that there's an American purchaser. Now, this American purchaser has already identified, again, I must emphasize that I'm using simplistic numbers only to make my point, and not as a reality statement here. But let's assume that U.S. investor is a very strong investor and has a AAA piece of U.S. real estate akin to a bond, and the investor knows that he can finance $18 million of the purchase price. And therefore, if he were to buy that $20 million building, he's got to put in $2 million in cash. Well, the American investor goes to the foreign owner of the foreign corporation and says, look, I'll give you $18 million for your stock. Not the $16,650,000 that you're going to keep. I'm going to reduce your taxes down to 20% of the game. Give you your money, walk away. Now, once that American investor buys that foreign corporation, the American investor does one simple thing. He changes the corporation from a foreign corporation to an American corporation by a transaction. In most states, it's called a domestication. It does not result in taxation, just to change the form of the corporation of where it's seated. And then he or she immediately elects Subchapter S. Because 10 years from now, that U.S. corporation is a subchapter S, and that's been cleansed by the 10-year period. The taxation of any of the gain from the sale of the property is taxed to the American individual, who's taxed at the 15% capital gains rate. Why is there a market? The American individual borrows $18 million, pays $18 million for the shares, makes enough income over the 10 years to keep paying the carrying charges on the $18 million. I'm assuming there's, over a 10-year period, the $20 million property is increased to $25 million. Therefore, we sell the property 10 years later. There's an $18 million mortgage on the property. The sales price is $25 million. There's a $7 million profit. The American investor pays a 15% tax, and the American investor walks away without a single penny being invested. Now you see why there's a market in this. These approaches can be used in almost any type of investment, and the effect of a treaty, if you can make use of it, can also make all the difference in the world. So I hope the message is, it's complicated, it's got some traps that can be avoided, and it's got some real significant benefits that can take a U.S. investment that can be made at the right time now and at the right price and show the right profit and reduce the taxes down on it to a very, very reasonable tax liability charge. Thank you.